Are you ready for the financial shockwaves coming in 2026? Hidden inside freshly signed laws are changes that could quietly drain the middle class, higher taxes, vanishing credits, and soaring bills on needs like healthcare, housing, and energy. Families who have relied on deductions or subsidies for years may wake up to find them gone overnight. These aren't small tweaks, they're shifts that could cost thousands of dollars a year. If you think your paycheck already feels stretched, wait until these laws kick in. Stay with us, because what you don't know now could define your financial future. Number 10. Medicaid and ACA program tightening. The final major change hitting in 2026 involves stricter rules for Medicaid and Affordable Care Act programs. Under the new law, eligibility checks and work or verification requirements will become more demanding. States will be tasked with stepping up oversight, meaning families who rely on these programs may face more paperwork, shorter response windows, and greater risk of coverage interruptions. Even households that technically qualify could lose insurance temporarily if they miss a notice or fail to verify income on time. For middle-class families that depend on subsidies or Medicaid expansions, this change threatens both financial stability and access to care. The consequences go beyond red tape. If people lose coverage, even for a short period, they may face sudden medical bills at the worst possible time. For example, a child's emergency room visit during a lapse could cost thousands of dollars out of pocket. Households already squeezed by higher premiums and reduced tax breaks will find these healthcare gaps devastating. Analysts warn that the tightened rules could push many families into debt or force them to skip care altogether. This shift reflects a broader push to reduce federal support for healthcare, with the middle class caught in the middle of a policy shift that raises both costs and risks. Preparation can reduce the chance of losing coverage. Families should set reminders to update eligibility documents, promptly open and respond to state or marketplace notices, and keep income records organized. Community health centers and federally qualified clinics remain options for those who lose coverage unexpectedly, often offering sliding scale payment systems. Exploring employer-sponsored insurance may also help if available. By staying proactive, households can protect themselves from sudden medical costs and keep essential healthcare within reach. The 2026 program tightening serves as a clear warning. Vigilance is now a survival skill for healthcare security. Number 9. Mortgage interest deduction locked to $750,000 debt. Home ownership in high-cost areas becomes even more expensive in 2026 because the mortgage interest deduction remains capped at $750,000 acquisition debt. Before temporary tax law changes, families could deduct interest on loans up to $1 million. Many expected that higher limit to return after 2025, but the new law makes the lower cap permanent. For households purchasing homes in cities where prices regularly exceed seven figures, this means a significant portion of their mortgage interest will no longer be deductible. The result is a higher effective cost of borrowing, which particularly squeezes middle-class buyers stretching to afford their first or second home. The impact is most visible in regions with soaring real estate markets, such as coastal cities and fast-growing metro areas. Imagine a family purchasing an $850,000 home with a mortgage covering $800,000. Under the new rules, only interest on $750,000 is deductible, leaving the rest fully taxable. Over a 30-year loan, that loss deduction translates to tens of thousands of dollars in extra tax liability. Even those refinancing may find themselves limited, as the cap applies regardless of interest rates. For families already balancing student loans, childcare, and rising healthcare costs, this policy shift makes homeownership less affordable and less financially rewarding. There are ways to adapt despite the cap. Larger down payments reduce the loan balance and maximize the deductible portion of interest. Structuring loans creatively, such as combining a first mortgage with a smaller home equity line of credit, may also help, though households must be mindful of total debt rules. Accelerating repayment with biweekly payments can cut interest costs over time, easing the impact of the deduction limit. For middle-class buyers in expensive housing markets, planning financing strategies carefully will be essential to prevent the permanent cap from derailing long-term financial stability. Number 8. Miscellaneous itemized deductions gone for good. Another financial setback arriving in 2026 is the permanent elimination of miscellaneous itemized deductions. These deductions once allowed taxpayers to write off expenses such as tax preparation fees, unreimbursed work expenses, and investment-related costs. For years, sales professionals, nurses, educators, and others who regularly spent their own money on essential tools or travel depended on this deduction to ease the burden. After 2025, those write-offs vanish completely, leaving many workers paying out of pocket with no federal relief. The change may not grab headlines, but for middle-class households, the loss adds up quickly over time. The people most affected are those in jobs that require frequent out-of-pocket spending. A traveling salesperson who covers gas, lodging, and supplies could easily spend several $1,000s each year. A teacher buying classroom materials without reimbursement faces the same issue. Before, a portion of those expenses could reduce taxable income, softening the impact. Now, with the deduction gone, every dollar comes directly from the household budget. Combined with higher healthcare premiums and housing costs, the absence of this relief makes it harder for families to save or invest. For workers already living paycheck to paycheck, the removal of this tax break adds invisible but heavy pressure. To adapt, employees should explore whether their workplace offers an accountable plan which allows employers to reimburse expenses in a tax-advantage way. For educators, small above-the-line deductions may remain available, so keeping accurate records is vital. Professionals who often cover job-related costs should negotiate reimbursement policies as part of employment agreements or consider jobs that provide stronger support structures. The disappearance of these miscellaneous deductions is a reminder that financial planning requires close attention to tax law. By understanding the change and pushing for workplace solutions, households can protect themselves from this hidden but damaging expense. Number 7. The moving expense deduction permanently eliminated. Starting in 2026, job-related relocations will hit wallets harder because the moving expense deduction will remain permanently eliminated for most taxpayers. For decades, workers could offset some of the costs of relocating for a new job by deducting expenses like transportation, lodging, and storage. That relief is gone, except for active duty military under certain conditions. This change means that everyday professionals who must move for career growth will face higher out-of-pocket expenses, even when the move is not their choice, but a job requirement. For middle-class families balancing mortgages, rent, or school costs, the extra financial strain is significant. The reality of modern employment is that relocation is often unavoidable. Whether it is chasing new opportunities, responding to corporate transfers, or moving to areas with stronger job markets, families increasingly face geographic shifts. Without the deduction, a $5,000 to $10,000 move becomes fully taxable with no federal offset. That money could otherwise fund essentials like childcare, retirement savings, or emergency reserves. For households already struggling with higher healthcare premiums and reduced tax breaks in 2026, the permanent loss of this deduction piles on another layer of financial pressure. There are still strategies to reduce the sting. Workers facing relocation should negotiate for relocation packages that cover more than just basic moving costs. Asking employers to offer gross-ups, extra pay to offset tax liability, or direct payments to moving companies ensures employees are not left covering taxable reimbursements. Families should also track all moving-related receipts, as some states may still provide partial relief even if the federal government does not. Planning moves carefully, comparing service providers and timing expenses strategically can also reduce the financial hit. The end of this deduction is unavoidable, but thoughtful preparation helps families manage the higher cost of moving in 2026. Number 6. Clean power credits phase out and restrict faster. Another change in 2026 comes from the accelerated phase-out of clean electricity production and investment credits. These credits were designed to support wind, solar, and other renewable projects by lowering development costs, which in turn helped utilities keep electricity rates stable. With the new timeline, Projects that start or finish after certain cutoff dates will no longer qualify for the same level of support. The shift means fewer financial incentives for utilities to build or expand clean energy plants, raising the possibility that costs will be passed down to consumers in the form of higher monthly bills. For middle-class families, the effect shows up subtly at first, but becomes harder to ignore over time. When utilities face higher construction and financing costs, they typically adjust rate structures to cover the difference. That could mean a steady rise in residential electricity bills beginning in 2026 and beyond. Combine this with the loss of household-level energy credits, and families may find themselves paying more both at the utility level and at the personal project level. What once looked like a future of cheaper renewable energy could temporarily turn into rising costs for average households, squeezing budgets further. The best response is to take control of personal energy use now. Performing a simple home energy audit can highlight waste that leads to higher bills, from drafty windows to inefficient appliances. Exploring fixed-rate utility plans might help stabilize monthly payments, though families should weigh the risks if prices later drop. Creating a small bill buffer in household budgets for 2026 is also wise, ensuring rising electricity costs do not lead to financial stress. While households cannot control utility policy, they can prepare by cutting unnecessary usage and staying alert to new local programs that ease the cost of clean energy transitions. Number 5. The Home and EV Charging Equipment Credit ends. Electric vehicle ownership is set to become more expensive starting in 2026 because the alternative fuel refueling property credit officially disappears. This credit currently helps homeowners and small businesses offset the cost of installing EV charging stations by covering up to 30% of qualifying expenses. For a household installing a $2,000 Level 2 charger, the credit saves around $600, a meaningful reduction. Without it, all installation costs fall directly on the consumer. As more drivers transition to electric vehicles, losing this support risks slowing adoption at a time when charging accessibility remains a top concern for families considering the switch. The burden extends beyond individual households. Small businesses that hope to attract EV driving customers by installing chargers will face higher costs as well. With no federal support, many may delay or cancel planned projects, which could limit charging infrastructure growth. For everyday drivers, that translates into fewer charging options, more range anxiety, and potentially higher costs at public stations. The change is especially tough on middle-class families who bought EVs to save on gas, only to discover that upgrading home infrastructure now carries a much steeper financial hit. What once felt like a smart long-term investment could begin to feel out of reach. Preparation is key for anyone considering an EV purchase in the near future. Homeowners planning to install chargers should act before the 2025 deadline to capture the credit. For those who miss it, checking with local utilities is essential, as many offer rebates or special time-of-use rate programs that lower charging costs. Some states also provide grants or incentives to expand charging access. While the loss of the federal credit makes the upfront cost higher, stacking local benefits can still create meaningful savings and keep EV ownership practical for middle-class households. Number 4. The residential clean energy credit cut short. Homeowners planning to go solar or install backup batteries in 2026 will face another financial hurdle. The popular residential clean energy credit, which has been providing a 30% credit on solar panels, geothermal systems, and energy storage, will no longer be available after 2025. This early cutoff means families waiting until 2026 to invest in clean energy solutions will pay thousands more out of pocket. A $20,000 solar project that previously offered a $6,000 credit will suddenly deliver no federal savings at all. For many households, that difference dramatically changes the payback period, stretching it years longer and making renewable energy less accessible to the middle class. The timing of this change is particularly damaging since energy independence has become a growing priority. Rising electricity prices, grid instability, and climate concerns have pushed many homeowners to consider rooftop solar and battery backups. Without the 30% credit, however, adoption rates could drop sharply, leaving families more vulnerable to high utility bills and power outages. Contractors and clean energy companies also anticipate reduced demand, which may raise installation costs further as economies of scale decline. What was once a realistic path to lower bills and sustainable living risks becoming an unaffordable luxury for average households. Still, there are strategies to soften the blow. For those unable to install systems before 2026, community solar programs may provide access to renewable energy at lower costs without large upfront investments. Power purchase agreements and solar leases also remain options, allowing families to benefit from clean power without paying for full installation. Homeowners should also monitor state-level credits, rebates, or performance incentives, which can still offset expenses. Acting early in 2025 is ideal, but for those caught by the 2026 cutoff, exploring these alternative solutions will be key to keeping energy costs manageable. Number 3. The home energy upgrade credit ends early. For homeowners hoping to save on energy bills through upgrades, 2026 delivers a tough surprise. The energy-efficient home improvement credit, which currently covers up to 30% of qualifying improvements like new insulation, windows, or heat pumps, will no longer be available after 2025. Originally, this credit was scheduled to last until 2032, giving households nearly a decade to plan eco-friendly renovations. But with the law cutting it short, those who delay projects until 2026 will face significantly higher upfront costs. Instead of paying 70% of the price and claiming 30% back at tax time, families will now shoulder the entire burden without federal support. This shift especially affects middle-class households that carefully budget for home improvements. A $10,000 upgrade that would have come with a $3,000 tax credit in 2025 will cost the full $10,000 just a year later. For many, that difference can determine whether a project is affordable at all. Beyond lost savings, the policy change may discourage energy efficiency at a time when utility bills are climbing and climate concerns remain pressing. The sudden loss of this incentive could create a ripple effect, with contractors seeing fewer projects and households missing opportunities to lower long-term expenses. There are still ways to reduce the impact. Homeowners who can act before the deadline should prioritize finishing planned upgrades in 2025 to lock in the credit. For those who must wait until 2026, state-level incentives and utility rebates can soften the financial hit. Some states offer generous programs for energy-efficient appliances, while power companies provide cash back for installing efficient systems. Keeping track of these local opportunities will be critical. While the end of the federal credit makes projects more costly, strategic planning can still help families save money and improve their homes. Number 2. The SALT deduction cap, made permanent. One of the most debated provisions in recent tax law is the state and local tax deduction, commonly known as SALT. For years, taxpayers in high-tax states relied on this deduction to reduce their federal tax burden. Under earlier rules, deductions for property taxes, state income taxes, and local taxes were far more generous. However, starting in 2026, the latest budget law cements a permanent cap, while raising it modestly to $30,000 for some households. On the surface, that sounds like an improvement, but the phase down for incomes above $400,000 ensures that many middle to upper middle income families in expensive regions will still see limited relief. The financial impact is significant for homeowners in states like New York, California, and New Jersey, where property taxes and state income taxes run much higher than average. Imagine a family paying $20,000 in state and local taxes annually who previously wrote off the full amount. With the cap locked in place, part of that burden becomes non-deductible, effectively raising their taxable income and federal tax bill. Over time, this can eat into savings for education, retirement, or even emergency funds. While renters may not feel the effect directly, property owners in high-tax areas often pass these costs along, contributing to rising housing expenses. Families can prepare by running tax projections for 2026 rather than waiting until April. Adjusting paycheck withholdings early helps avoid a surprise tax bill. Another strategy is bunching deductions, timing charitable contributions or property tax payments so they fall in the same year, maximizing the limited benefit that remains. Exploring other tax-efficient tools, like health savings accounts or retirement contributions, can also reduce overall liability. The bottom line is that this permanent SALT cap reshapes household budgets, and being proactive is the only way to stay ahead. Number 1. The ACA Enhanced Subsidies Sunset. Starting in 2026, millions of Americans could wake up to shocking health insurance bills because the extra financial help created during the pandemic will officially end. These enhanced subsidies, also called expanded premium tax credits, were designed to make Affordable Care Act plans more affordable. For years, many middle-class families enjoyed lower monthly payments and expanded eligibility, even if their incomes were slightly above past limits. But once the subsidies expire after 2025, those very same households may face premiums that are hundreds of dollars higher every single month. Analysts from respected health policy organizations warn that the change will be one of the most immediate financial shocks of 2026. The impact hits hardest on the middle class, especially families who earn too much to qualify for Medicaid but still rely on the ACA marketplace. Imagine a family of 4 paying $300 per month in 2025, suddenly facing a jump to $800 or more in 2026. That extra cost is not optional. It is a basic necessity. The timing makes it even tougher, as other tax and deduction changes arrive simultaneously. People who have come to count on the relief may feel blindsided, especially in states with higher premiums to begin with. The reality is clear: unless Congress takes last-minute action, 2026 could bring a wave of premium hikes that drain disposable income. There are steps you can take to soften the blow. Start by reviewing your eligibility for cost-sharing reductions, which lower out-of-pocket expenses for certain households. Ask your employer whether an individual coverage health reimbursement arrangement (IIRA) is available, as this can help offset marketplace costs. Shopping carefully during open enrollment will be essential, because off-exchange plans may sometimes provide lower overall value. By preparing now, families can avoid being caught off guard by one of the most expensive law-driven shifts of As we have seen, 2026 is shaping up to be a year of major financial challenges for the middle class. From the end of healthcare subsidies to the permanent cap on SALT deductions, from the loss of home and energy credits to tighter Medicaid rules, each change adds another layer of pressure. Alone, any one of these laws might seem manageable. Together, they create a perfect storm that could erode savings, increase monthly bills, and make it harder for families to plan for the future. These are not abstract policies. They touch everyday life: housing, medical care, taxes, and even electricity bills. The good news is that awareness creates opportunity. By understanding what's coming, families can take steps now to prepare. Whether it's completing home upgrades before credits vanish, adjusting tax withholdings to account for lost deductions, or negotiating stronger relocation benefits from employers, proactive planning can soften the blow. Healthcare shoppers can start comparing off-exchange options and preparing documents early to avoid coverage gaps. Homeowners can explore community solar programs or energy audits to keep costs manageable. Each small action adds up, and taken together, they can shield households from the sharpest edges of these changes. 2026 will test the resilience of the middle class, but it doesn't have to spell financial ruin. With careful planning, smart adjustments, and a willingness to stay ahead of shifting laws, families can navigate these changes more effectively. Knowledge is power, and the earlier you prepare, the stronger your financial position will be when these laws arrive.